My name is Scott Saunders, and I'm a Senior Vice President with Asset Preservation. Also on the webinar with me is Erin Crowley. She's the Colorado Division Manager with Asset Preservation. If you've got questions or chat as we go along, feel free to ask those in the chat bar. So Erin's going to be kind of monitoring those during the webinar and asking the question or chat, whatever's more comfortable to you there, and she will address those. So we're going to cover a lot of information. You can see by the screen there, I've been doing 1031 exchanges for about 29 years. And what I really want to do is shed some light on things from a closing perspective, let you know what's going on in the marketplace now, and really expose you to a lot of information in a short period of time. So you can see in the outline there, we're going to cover quite a bit of information. I really want to make sure that whether you're a veteran or somebody who's fairly new, you get something out of this. That's really my goal. So you'll see we're going to cover quite a bit of information. And with that, let's just go to the next slide. And what I want to start off with, and I'll cover this relatively fast, is just start the foundation. You hear all these buzzwords as they relate to 1031 exchanges, kind of 1031 lingo. These are the basic words that come up, and I want to just hit upon what the simple definition is. So when you hear your clients and customers talking about these things, you've got an idea. Boot is simply defined as non-like-kind property. And there really are just two types of boot that we run into primarily. Cash boot is the receipt of proceeds out of the transaction, and we're going to talk a little bit later how to handle that on your settlement statements, where people can get cash boot, because there are a couple of ways that they can pull it out. The other type of boot is called mortgage boot. This is sometimes referred to as debt relief. So this is a reduction in your client's mortgage liabilities in regards to the property they're giving up, which we call the relinquished property, versus the property they acquire in the 1031 exchange. Constructive receipt's an important concept. This means that even though your client may not physically have the money from a sale transaction, they're legally entitled to it in some manner, such as having it held in your escrow or trust account. And so where this comes up sometimes is where somebody maybe closes a transaction, and a day or two later, the proceeds haven't been dispersed out. They decide, oh, I want to set up a 1031 exchange. That's no longer possible because the IRS says they have what's called constructive receipt of the funds. So it's really a fully taxable sale, and there's no way to unwind a transaction that's closed and make it an exchange after the fact. That's just not possible. Direct deeding is what you'll see in most delayed exchanges. This is the direct transfer of title from your client, the seller, to the buyer on the sale transaction, and then on the purchase transaction from the seller back to the exchanger, the one who's buying the property. We'll refer to the person that does an exchange as either a taxpayer, exchanger, investor, your client, synonymous. The exchange agreement is the agreement prepared by the qualified intermediary, and it puts certain restrictions on the money while it's being held by the qualified intermediary. The exchange period is a maximum of 180 calendar days. Now, believe it or not, and we'll get into this later, it can be in certain situations longer, or it can be shorter, and we'll address that a little later in the presentation. So just want to mention that. The identification period is a period of 45 calendar days after the transaction closes. So your client has till midnight of the 45th day to identify property. Like-kind property is very, very broad when we deal with real property. It's essentially any real property exchanged for any other real property that's held for investment purposes. And we'll look at all the different types a little later in the presentation. Mortgage boot, we already touched upon. It sometimes is called debt relief. The qualified intermediary is what the IRS calls that middle entity that structures the exchange and holds the funds. But some other terms you may hear qualified intermediary referred to, sometimes as an intermediary, sometimes as an accommodator, sometimes as a facilitator, and sometimes as a QI. Again, those are all synonymous terms. Relinquished property is the property that's given up in the exchange, sometimes called the sale property or the down leg property. Replacement property is the property being purchased. Sometimes that's called the purchase property. Could be called the phase 2 property or the up leg property. So if you're dealing with clients that are coming out of, let's say, Southern California, they may refer to these transactions as up legs and down legs. So I just wanted to kind of give you that street talk there. Sequential deeding is used in parking arrangements when an entity owned by the QI is parked on title. So with that, let's start getting into the meat of the presentation. Now that we got the basic terminology. Right now, we're seeing what I call the perfect storm for a huge surge in 1031 exchange activity. Your clients are facing much higher capital gain taxes, and I don't have a bullet point on this, but I'll let you know that percentage-wise, when taxes went up back in 2013, the percentage increase with capital gain taxes is a 57% increase percentage-wise. So it's very significant. Your clients are facing a higher federal capital gain tax and the addition of the 3.8% net investment income tax. So here in Colorado, we've got one of the best real estate markets in the country. Residential is very strong, so people with single-family rentals have significant gains. Commercial is very strong, and frankly, in a lot of areas around the country, the markets are strong, and we have people exchanging into Colorado for replacement property. So your clients are seeing a lot of appreciation. On the commercial side, they're seeing rising rents, which increases the value of properties. And the bottom line is, we have a lot of Colorado investors that are looking to reduce their tax liability and turn into a 1031 exchange. So let's look at what your clients face if they don't do an exchange. They really have 4 potential levels of taxation, and some of your customers may not be aware of all this. They first have taxes on the depreciation recapture at 25%. So if you've got a customer that owned a property for 25 years, they're going to have to recapture all of that at a rate of 25% if they don't do an exchange. Then the remaining economic gain at the federal level is taxed at either 15 or 20%, depending upon their tax bracket. Some investors, particularly commercial investors, face this additional 3.8% net investment income tax, and I'll cover that in just a couple slides where those thresholds kick in. And then finally, you've got the addition of the state taxes. So here in Colorado, that's 4.63%, but in other states it can be a lot higher. Investors coming from California face a maximum state tax rate of 13.3%. So the tax side of it is really driving a lot of the interest in exchanges. You'll see in the second bullet point down, the 20% rate, the higher 20% rate, is applicable for single filers with $400,000 in taxable income and married couples filing jointly with over $450,000 in income. One thing to take note of, there really is a significant marriage tax penalty here. If this would have been equitable, it would have been set at $400,000 and $800,000. And then on the next slide, you'll see with the net investment income tax, that applies to any net investment income, and that includes capital gains. So anybody over these thresholds pay an additional 3.8% tax. So that's $200,000 for single filers and $250,000 for married couples filing jointly. Again, if it would have been equitable, it really would have been set up at $200,000 and $400,000. So clients of yours that are married really are facing these new taxes much earlier than the single filers. So that's the tax side of it that's driving 1031 activity. Let's look a little bit at the market. Nationally, the commercial market, I really look at investment real estate as both. You got the commercial market and you've got the residential, and they're kind of separate markets even though they're both investment properties. Nationally, prices with commercial real estate ended up last year 24% above the previous peak back in 2007. So they're way above that. And in Colorado, if you look at the last bullet point, we've really had a surge around the metro area, and it's really spread out to a lot of other cities with a lot of the cannabis businesses, both grow houses and retail, particularly in the grow house side, has had a huge impact on the demand for industrial property. In fact, the rents for cannabis properties are significantly higher than they were for B and C class industrial. On the residential side, and I know this, we probably have people from different parts of the state on board, but in the Denver metro area, prices are 40% or more above the previous market peak. So on the single family rental side, you're seeing nationally home prices up about 6%. Single family rents are increasing at about 2 to 2.5% a year. So at the bottom line is, there's one aspect of the tax code called the 1031 exchange that allows anybody selling any property held for investment to defer all 4 levels of taxes that they'd otherwise incur. So your clients in Colorado really have just 3 options with their investment properties. One is a buy and hold strategy. And there's nothing wrong with that, and a lot of investors do it, but I'll just suggest if maybe your clients are in a part of the state where there's not a lot of job growth and not of a lot of appreciation, maybe it makes sense to exchange out of those properties, come into a part of the state where there is a lot of job growth and a lot of economic growth happening. So maybe exchange into the greater Denver metro area or northern part of the state. There are a lot of pockets of opportunity. Now the other alternative is to sell the property and pay all the taxes. So again, all 4 levels of taxes, the depreciation recapture at 25%, federal economic gain at 15 or 20, net investment income at 3.8% when it's applicable, and then our Colorado state tax. Here's the challenge with that scenario. It's almost impossible to get the same return on investment with after-tax dollars in investments outside of real estate as it is to have all of the gross equity redeployed into another investment property. So people that want to liquidate, maybe you're near retirement, this might be a strategy, but it's very tough to get the same return. The final option is to do a 1031 exchange. Now, people can do a fully deferred exchange where they defer all the taxes, but I want to let you know one thing we've seen in the marketplace, both Aaron and I, is we've seen a lot of investors choosing to have partial tax deferral. They take some money out, which is taxable boot, and then they do a 1031 exchange into another property. So just keep in mind a 1031 exchange is not an all or nothing proposition. Many investors opt for partial tax deferral. Now the code has been with us since 1921, so for quite a long time, and it just simply says this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or investment. Some key takeaways. This is called non-recognition treatment. It's not a tax-free exchange, it's a tax-deferred exchange. So sometimes you hear that being said incorrectly. And the types of property that can be exchanged are very broad. And a business property for another business, an investment for an investment property for a business property, or a business property for investment. So very, very broad there. Now when we look at some things you can't exchange, stock in trade or other property held primarily for sale is excluded. So stock in trade is inventory held for sale in the ordinary course of business to customers. So think of somebody like a home developer putting up a subdivision. That's excluded. But the other part of this really does catch a lot of people. In our world of real estate, we know the term a fix and flip, or somebody gets a property at a good value and they're going to turn it in a short period of time. If the intent with that property is to hold primarily for sale, they're not eligible for 1031 exchange treatment. And we'll look at that on just the next slide. I want to draw your attention down to the 4th bullet point. An interest in a partnership is excluded. So keep in mind, any entity at the entity level can do an exchange. A partnership can do an exchange, an LLC, an S Corp, a C Corp, an individual, a trust. But an interest in a partnership is really an interest in personal property. So the partnership owns real property, but my interest in the partnership is really a personal property interest, and it's excluded. It's not on the screen, but we often get asked about what about a share in a REIT, a real estate investment trust. That's also excluded under the same rationale. So you can't do an exchange into a share in a REIT, even though REITs hold real estate. So we as a qualified intermediary do exchanges for a lot of REITs, but you can't exchange into REIT shares. When we look at property being held for sale, there really isn't what we call a bright line test on this. There's no clear-cut answer. The IRS is going to look at the overall flavor. Does it tend to look like it's being held more for long-term investment, or do the factors tend to indicate it's being held for sale purposes? So they'll look at the purpose of what property is initially acquired, how was it held during the term of ownership? And certainly, how was it being held at the time of sale? The extent to which improvements were made to the property. So if someone buys a piece of land and they cut in roads and run in utilities, they look a lot more like they're a dealer or developer than somebody holding property for long-term investment. The frequency, number, continuity of sales, extent and nature of the transaction. The next one's interesting, the ordinary course of business of the taxpayer. If you have a customer of yours that maybe is a dentist, and in 1 year they turn over 2 properties, that's a very different fact pattern than maybe a customer who is a developer or a real estate broker that makes all their income turning over real estate. So you really have to look at that piece. It's the last 2 that really catch a lot of taxpayers. Any active efforts used to obtain a buyer for the property or the listing of a property with a real estate broker. That makes it look like it's being held for sale, not long-term investment, and would exclude it. Now, the next issue we run into quite a bit, a lot of your customers are going to hold title to commercial properties and other investment properties and LLCs and partnerships for liability protection. So let's just say in a simple situation, you've got a partnership with 3 partners. 2 of the partners want to exchange. 1 wants to cash out and pay the taxes. You can't do an exchange on a partnership interest, as you see on the screen. So what you've got to do is convert an interest in the partnership into an interest in the real property itself. And the way that we do that in the exchange world, and you might have heard this terminology, there are 2 different terms that are referred to. One's called a drop and swap approach. The swap means the 1031 exchange. The other is called a swap and drop. So in a drop and swap, this involves the partnership deeding out to the former partners, so they're all now tenant in common co-owners. So those 3 people co-own it as tenants in common. Then when they go to sell the property, the one individual that wants to pay the taxes pays the taxes on the sale. The other 2 former partners, now tenant and common owners, do a like-kind exchange, and let's say they work with separate intermediaries and they go their separate ways. So that by far is the most common approach. The other option is what's called a swap and drop. So this would be keeping the partnership or LLC intact, buying a new replacement property, and then after that point in time, dropping out of it. So these are the 2 common approaches. The big point to keep in mind is the more time that passes between the drop out of the partnership or LLC and the actual exchange, the better. And I can't give you a hard and fast rule, but the shorter the time period, the more risky it is. The longer, the more conservative it is. There are a number of federal tax court cases that are very friendly to taxpayers, but as you see on the second bullet point, right now in the state of California, the Franchise Tax Board has taken the position that they're not bound by the federal tax court decisions. And at the state level, they're auditing a lot of exchangers. In fact, many, many exchangers that drop out of a partnership at the very last minute, and they're collecting state level taxes. So anybody that was working with a client in California that's contemplating this, definitely it's important they talk to their tax and legal advisors. Keep in mind, you do have to disclose this to the IRS. So on the IRS Form 1065, the partnership return, you're going to have to tell them that you dropped out before or after the exchange. So you're going to have to give that information to them. One creative approach that you may or may not have heard of is what we refer to as a partnership installment note. Now this is a way where, very similar to a normal installment sale, the partner that wants to cash out, instead of them getting all the money today, they get some money today. The qualified intermediary creates a note with them and then pays them the remaining amount in the next tax year. So let's say in this case in 2018. That allows them to spread their tax liability over 2 years. So this is a creative option that's out there and something to keep in mind. Now going to issues that you deal with as a closer here in Colorado. You know, the issue and the general principle is you want the same tax owner that relinquishes a property to be the same tax owner that purchases the replacement property. So very simplistically, you have the wife relinquish, you want the wife to acquire. LLC relinquishes, LLC acquires, etc. keep in mind, if you have one member that's of a married couple, wife relinquishes, and they want to buy as husband and wife on the replacement property, they got to be very careful that they meet their exchange requirements. So if a wife sells a property for $300,000 and they buy a replacement property for $400,000, the wife really only owns $200,000 of it and ends up with some taxable boot. So be very careful when you're dealing with situations where maybe you've got couples that have remarried and they've got separate assets. We generally recommend to try and keep those segregated out for purposes of the exchange. Keep the vesting consistent on the sale property and on the purchase property. Now, it's not critical that the vesting's identical, so I gave you some examples. You can have somebody exchange out as an individual. So Erin Crowley can exchange out as an individual, and she can go in to an LLC that is a disregarded entity for federal tax purposes. So the federal government really looks past the LLC and considers it a disregarded entity. Everything would flow to Erin Crowley. So there are different planning opportunities there. Now, the area where things get exciting with exchanges is this whole concept of a like-kind property. Sometimes you hear people say like for like, land for land, improved for improved. It's very broad. And here in Colorado, we have some very creative planning opportunities that, a lot of people take advantage of. Things like vacation homes that are held for investment. So on the screen, you're going to see a lot of images that are all like-kind property. And some things on there like that oil and gas property, you might never think of it as being like kind, but it can qualify for a 1031 exchange. The types of property that are excluded are really two types. Number one, the taxpayer's principal residence, the house they live in. Number two, any property that's held primarily for sale purposes. So when we deal with real property, any real property can be exchanged for any other real property held for investment. Personal property, and lots of those are done. We do exchanges on personal property, on corporate aircraft, on heavy equipment and machinery, on farming equipment, on fleets of cars. Those rules are much more narrow and specific. You would have to exchange an aircraft for another aircraft. When we deal with real property, as long as it's considered real property under state law, it can generally be exchanged for any other real property anywhere in the United States. And it has to be domestic. You can't exchange out of the United States. It's got to be U.S. property for U.S. property. So in Colorado, a great planning opportunity is this whole concept of a vacation home. So let me be clear. If it's a second home and it's not been rented, if it's truly a second home, it's not eligible for 1031 exchange tax deferral. It has to meet this revenue procedure to be considered held for investment. So the easy way to remember this is what I call the rule of twos. There's a 2-year holding period, and within each of those years, the taxpayer must rent it for a minimum of 2 weeks, and their personal use can't exceed 2 weeks or 10% of the time it's rented. So if they meet those 3 requirements, 2-year holding period, minimum of 2 weeks of rental income in each of those years, and no more than 2 weeks of personal use, they've then met the exchange requirements. And as you'll note on the slide, you can rent to a family member as well, as long as it's at fair market rent. So that's the key issue in that area. So that's a huge planning opportunity in the state of Colorado, and depending where you're located, you may or may not see a lot of those. In Colorado, we do lots of exchanges of easements. Conservation easement, we did a large one outside of Boulder not too far back, millions and millions of dollars, and it was part of a 1031 exchange. Agricultural easements, and then one that I think is an interesting opportunity is what's called a perpetual communication easement. It's simply a cell tower. That could be in a rural location, it could be in a metropolitan area, but we do a lot of exchanges on that. And then here in Colorado, water is a big issue, and water rights and ditch stock. So water rights qualify as like-kind property under state law. And there was a change back in 2008 that provided for ditch stock being included in a 1031 exchange as long as it's considered real property under state law. So it's a couple of opportunities there that you may or may not have heard of. One that we've seen a big interest in is what's known as fractional ownership. And a number of years back, 15 years ago, these were done as DSTs, or Delaware Statutory Trusts. Most of them today are done, Years ago, they were done as a TIC, tenant in common ownership, apologize. Today, they're done as DSTs, Delaware Statutory Trust. The big advantage of these is that you can go into relatively passive ownership. So you come out of multiple single-family rentals and can go into a slice of a much larger commercial building that somebody else manages. So passive ownership is the biggest advantage. The risks, at the end of the day, you're still going into real estate, so you want to like the market, you want to like the tenants, the leases, you want to certainly look at the track record of the sponsor that puts these together. So I've listed there a website if you want more information on this, the Alternative and Direct Investment Securities Organization. And by the way, these are sold through licensed financial advisors, not through real estate agents and brokers. And they're only sold to accredited investors. So not everybody qualifies for a DST, but we're seeing a big uptick in DST interest these days. Now, a question you may have asked yourself or have heard is this question: how long do you have to hold a property before it's considered held for investment? And the answer is this: there is absolutely no holding period anywhere in the tax code. There is not a mandatory year and a day, 18 months, or 24 months. What the IRS is going to look at is what is the intent of that investor. Did they intend to hold it for long-term investment, or was it intended to be held short-term? So they're going to look at all of the facts and circumstances. So my intent and your intent is internal. The IRS is going to look at objective factors, provable facts that help document the investment intent. So in a perfect world, your clients would have a lot of factors, a lot of facts and circumstances that help substantiate the intent to hold for investment. If they don't, then it leaves them in a riskier position. So, and I'm not going to go through these tax court decisions. Goolsby below 2010 decision is where somebody moved into a property only 2 months after they did an exchange. They never intended to rent it, and they didn't. It was not permitted 1031 tax deferral. The one, below that, Reesink versus Commissioner in 2012, and this one, the taxpayer only had an 8-month holding period. So they did an exchange. 8 months later, they moved into it. And in Reesink, the IRS determined that they did have sufficient facts and circumstances to show that it was held for investment. So you can see some of them there. The taxpayer showed it to a number of tenants that they didn't even rent it, but they showed it. They put signs around town that it was available for rent. And then they happened to have a situation where it was a married couple. One of the individuals lost their job and they couldn't afford the mortgage on their house. So 6 months after the exchange, they sold their house, moved into their property, which happened to be located in Northern California. But I bet you, for some of you on this webinar, you probably never heard of a time period as short as 8 months qualifying. So I can't overemphasize the importance of an intent to hold for investment. And then a really good thing for your clients to do is have them document that intent. Have them send an email to their tax or legal advisor, maybe their broker, and saying, we're buying such and such property which we intend to hold for investment purposes. That way, if they're audited later on down the road, they've now created that documentation to substantiate the investment intent. Well, what do your clients need to do for full tax deferral? Just two things. Number one, reinvest all of the net exchange proceeds. So net's going to be after closing costs. And this is where things get tricky on settlement statements. So we're going to jump into that shortly. Also, they have to have the same or a greater amount of debt. So sometimes you hear people say, buy of the same value, and that's not technically accurate. The critical aspect is they've got to reinvest all of the net proceeds after exchange expenses are pulled out and have the same or greater debt. So you'll see an example here where somebody sells a property for $900,000, their mortgage is $300,000, closing costs, and we'll look at this in a moment, are $60,000, leaving them with net equity. They go up in value. They buy for $1.2 million. Their debt goes from $300,000 to $660,000, so they have no mortgage boot. Net equity is all reinvested, so this is full tax deferral. They have a fully tax deferred exchange with no boot on this one. Now, next example, taxpayer goes down in value. So their debt goes from $300,000 to $260,000. They have $40,000 of mortgage boot. They put $100,000 in their pocket, $100,000 in cash boot. Add those two together, there's $140,000 total boot. Now, something to keep in mind, boot may be taxable, but it may not be. If the taxpayer has things like carry forward losses, they might be able to offset some boot. So it's very important that you direct them back to their CPA to look at their specific situation. Final example here is where somebody reinvests all the equity, but they went down in debt. They have $40,000 of boot. So it's really important that your clients look at both the equity that's being reinvested and making sure that they've got a mortgage as much as they gave up on the replacement property, or they could split that on a number of properties. There are a number of different ways to do an exchange. The most common way, what's known as a delayed exchange. So the process is your client's above, that's the taxpayer, the investor, they get a property under contract. Prior to closing with you, they contact a qualified intermediary. We prepare an assignment of the contract. The qualified intermediary is assigned in. So the intermediary sells the property to the buyer, and we're going to instruct you as the closing officer to deed it directly. The buyer gives the money to the qualified intermediary. Now they look for a property they want to buy. They get that under contract. That contract is again assigned to the qualified intermediary. We step into the shoes as the buyer, purchase the property, and then instruct the closing officer to directly deed it back. So that's what it looks like in a typical delayed exchange. And as you see, nowhere does your client have access to the money. The qualified intermediary is on the settlement statement as the seller. The qualified intermediary is on the settlement statement as the buyer. So let's look at these timelines, and I touched upon them. 45 days from closing till midnight to identify, that's called the identification period, plus another 135 days, so a maximum of 180 days, which is called the exchange period. Well, there are a couple of exceptions to that 180-day exchange period. It's 180 days or the date the taxpayer must file its tax return for the sale of the relinquished property, whichever is earlier. So if you have a client that closes after October 17th, so just a week away, anybody after that that files their tax return on April 15th, what they need to do is file an extension, close their exchange in 180 days, and then file their tax return. So this is a scenario where they could have less than 180 days. Where could you have more? Well, any taxpayer that has a property or tax records in what's considered a disaster area, a presidentially declared disaster area, they're eligible for a 120-day extension of the 45 and 180-day periods. But you got to fall in an affected county. So Hurricane Harvey back in Texas would qualify. Same with Irma in affected counties. Right now in California, they've got huge wildfires, and I would expect all of those counties will be presidentially declared disaster areas within the next few days. The identification rules, very straightforward. The 3 property rule, it means the taxpayer can identify 3 properties at any fair market value. So they sell for $1 million, they can identify one at $1 million, one at $2 million, one at $4 million. So you're limited on the number, but you have unlimited value. The 200% rule is kind of the opposite. You have an unlimited number of properties that you can identify, but the value can't exceed 200% of what you sell. So if I sell for $1 million, I can identify as many replacement properties, but the value can't go over $2 million. And then finally, the last rule is called the 95% rule, which says you identify more than 3 properties and more than 200%, then you must close on 95% of the value of the properties identified. Really what it means is you've got to close on pretty much everything. Identifying must be done in writing, and it must unambiguously describe the property. So if you're going to identify a condo down in Lodo, you don't identify a 2-bedroom, 2-bath condo. It's got to be unit 23 or unit 75, specific properties. By midnight of the 45th day, generally that's delivered to the qualified intermediary. I just want to point out what not to do, and the one I want to draw your attention to is Dobrik versus Commissioner. This is where an investor backdated their identification and they got audited. They were on the hook for their full capital gain taxes, $2.2 million in taxes, plus a 75% fraud penalty, another 1.6 million fraud penalty. So the rules are there, they're set in stone, and there's no wiggle room or latitude. And unfortunately here in Colorado, you know, the Denver metro area right now, inventory's tight. Properties turn over quickly. It's a tight market in a lot of places throughout the state. There's no allowance for that in the tax code. You've got to meet the time requirements regardless. This is a scenario where somebody sells 3 properties in a multiple property exchange. They're going to consolidate all that equity with the qualified intermediary by one larger replacement property. The key takeaway here is just whenever property number 1 closes, it now starts the time deadline for the remainder. So if you're going to sell multiple properties and exchange into one, you really have 180 days from when the first property sells to sell properties 2 and 3. The more common thing that we see in a multiple property exchange is this one here. Somebody sells 1 property, they're going to leverage themselves. They're going to buy multiple properties. So they buy, in this case, 3 replacement properties. That's what it looks like. Next thing I want to look at, and then we'll get into the closing issues on your end. Parking arrangements are situations where the QI is parked on title. So we're actually going to form an entity. We'll register to do business in Colorado, and we're going to be parked on title. The more common variation that you've heard of is what's called a reverse exchange. This is where we buy the replacement property before we close on the sale of the relinquished property. And right now in the marketplace in Colorado, we're seeing a huge increase in reverse exchanges, primarily because if a broker finds an off-market deal or maybe has a pocket listing, they can tie that up, and maybe that seller says we need to close right away. The reverse exchange gives them up to 180 days to now sell the relinquished property. An improvement exchange is when we're going to either build a brand new property from the ground up or make refurbishments to an existing one. So people do that on vacation homes, build it to their specifications. A reverse improvement is where we purchase the property first and begin making improvements to it before we sell the relinquished property. We see a lot of owner users doing that. We did one just recently on a feed supply store in northern Colorado where somebody created a new business. They kept their existing business operating, and then they built a brand new and larger facility. All the while they kept their business going on. So let's get into some of the closing issues. Number 1, can you set up a 1031 exchange at the last minute? Absolutely. As long as the transaction has not closed, you can convert a taxable sale into a 1031 exchange. So what do you need to do? Number 1, not proceed with the closing, right? Contact a qualified intermediary and explain to them that you're there at the closing table and need to set something up at the last minute. And this happens all the time. And I'll tell you, every month we have transactions at the end of the month where somebody was on the fence or didn't think about it, and at the very last day or hours before closing, they set up a 1031 exchange. The intermediary will go ahead and get the 1031 exchange documents emailed over, and then you can have the seller and buyer sign the appropriate documents. What do we need to set up an exchange? What do you need to provide a qualified intermediary? Just a few things. Your customer's contact information, your contact information, the property address and vesting, the vesting of the buyer, provide a copy of the purchase and sale agreement, and then if you have the title commitment, provide that and send that to the intermediary. The intermediary is going to prepare these documents: an exchange agreement, an assignment agreement to be assigned into the contract, and then a notice of assignment to the other party, so the buyer on the sale of relinquished property. There are going to be some exchange account forms. The money is being held, and those forms need to be prepared to have the money wired out and held by the qualified intermediary. And then finally, a qualified intermediary is going to provide you, the closing officer, with detailed instructions on how to prepare the exchange. So here's some things that you're going to do. You're going to show the qualified intermediary as the seller on the settlement statement. So you would have the name of the qualified intermediary, and the example I have there is, for John and Joan Smith. On the West Coast, they've got escrow instructions. We'll also show the intermediary as the seller. You want your client, the investor, to sign and read and approve all documents and closing statements before they're forwarded to the qualified intermediary, who will then sign as the seller. On the 1099-S, you're going to check box number 4, that other property be received as consideration. And then in most exchanges, certainly a delayed exchange, you're going to go ahead and you're going to prepare a direct deed from your client to the buyer. Only in situations that are reverse or improvement exchanges, parking arrangements, do you need to prepare a sequential deed. And the intermediary will give you that guidance and that input. Finally, the proceeds after the closing are generally going to be wire transferred over to the qualified intermediary. And we're going to look in a moment of how do you handle boot, because some of your clients might want some cash out, and I want to go through that. Some might want it dispersed right out of your transaction, and that's possible. Some may want some boot at the very end of the exchange. So if your client wants boot from your sale, you would then get instruction from them on the amount, show that amount as proceeds due their name, and then the remaining amount of the proceeds go to the qualified intermediary. Some other issues that come up on your end would be handling earnest money. How do you handle that? So on the sales side, when you're selling a property, what do you do if there's been money that's been put in there? What if it's been pulled out? Generally, as long as that money is put back into your account prior to closing, there's not going to be any boot with that issue. Where we get a lot of questions is working with closers on the purchase side. So how do you get the money over? There really are two ways. The intermediary can take the money they're holding and they can make the earnest money deposit on the purchase of replacement property, but only after they've been assigned into the purchase and sale agreement. So they now step into the shoes as a buyer. The other way to handle that is to have your client provide the earnest money up front, and then at the closing, the intermediary could go ahead and wire in all the money and offset that. And the way you would do that is you go ahead and show that on your settlement statement as a refund of the earnest money deposit back to the investor or the taxpayer. So a couple of different ways of doing it. Now here's where things get a little tricky for you. There are different costs in exchange, different fees. So there's a definition of something what's known as an exchange expense. That's really a transaction cost that's required to buy and sell real estate. So you'll see some examples: transfer taxes, the real estate commission, your fees, recording fees, the qualified intermediary fees, etc. Look at the next slide though. There's a whole bunch of costs that are typical in transactions that are not considered exchange expenses. So things like loan fees and points and loan app fees, homeowner association fees, hazard insurance, credits for lease deposits and security deposits. So these come up, and particularly when you're dealing with a commercial transaction, and they can get a little bit tricky as to how to handle them in an exchange. So I want to give you a couple of approaches, but these are very nuanced issues, but yet on a commercial transaction, they're very real questions that clients face. So some ways to handle things like the security deposits and other non-exchange expenses that might be considered boot. One way is to have the investor pay these amounts directly over to the buyer from an operating account, so you don't even reflect them on your settlement statement. That's one way to do it. Another way to handle these is to have the investor deposit an amount equal to all of these non-exchange expenses into your closing or escrow account. Then you go ahead and add those as an offsetting credit on your settlement statement. So those are really the two different approaches, and I wish I could give you a clear-cut answer as to which one's best, but different tax and legal advisors have different preferences. That's something you want to work with your client, but definitely flag that in a transaction involving a commercial property. Now, when can your clients get the proceeds? If they want some taxable boot, and you know they want taxable boot, the easiest way is to have that come out of the sale transaction when you sell the relinquished property. So have them state how much they want. If all the money goes to the qualified intermediary, the intermediary can only release the excess funds once the client has purchased all the property that they're entitled to under the exchange agreement. So let's just say your client identifies 3 properties, and on day 50 they buy 1. That remainder amount of boot can be returned to them, but under the exchange rules, what's called the G6 restrictions, the money can't be returned until day 181. So that's something that your clients, we try to, as a qualified intermediary, review that in advance. But it's something very important that they're aware of, that once that money goes to the intermediary, they can't get it back until they've purchased all the property that they're entitled to under the exchange agreement. Now here's an issue that's very relevant for a lot of us in the industry: tax reform. That's going on in Washington, D.C. It's not going smoothly, I can tell you that. The Republicans fumbled the ball on healthcare reform. They weren't able, they controlled the presidency, both the House and the Senate, and they weren't able to make any changes with healthcare. They are under a tremendous amount of pressure to get tax reform done. So there's a lot of pressure. Well, the issue is the Joint Committee on Taxation, what's referred to as a JCT, they scored that if 1031 exchanges were repealed, it would raise about $41 billion in revenue over a 10-year time period. So when the Republicans came out with their blueprint last summer, there was no language at all preserving 1031 exchanges. A couple weeks ago, the Republicans released their framework now for tax reform, and so you can see some aspects of it. Probably read a lot about this. They proposed 3 new tax rates for individuals at 12%, 25%, and 35%. They've left the door open for a higher rate. They're proposing a 20% corporate rate and a 25% pass-through rate. Unfortunately, where things get tricky with tax reform are what are called the pay-fors. How do you pay for tax reform so it's revenue neutral? So things like deducting mortgage interest, there is some debate. You know, will they allow that to be deducted? And that could really influence investors that own property. They've proposed expensing of assets. So that means writing off all in year one, but that will not include real estate. And then they've also proposed repealing many deductions and credits. One of the ones that's in the proposal is getting rid of the deduction for state and local taxes. Well, that certainly is a big issue, and investors in areas with high taxes are very, very concerned that if you can't deduct, it's going to put them in a worse situation. So when we look at tax reform, Ernst & Young did a study, said that if you eliminate 1031 exchanges, the negative impact on the GDP would be between 60 to 131 billion negative impact. So it would end up actually in a much more negative job loss. There was an article just yesterday in the Denver, I think it was the Colorado Real Estate Journal, on a transaction, a big commercial one, and the broker said that 1031 exchanges were between 60 to 70% of their business. It's a huge issue. NAR did a study and said 63% of realtors have participated in exchange, so it affects commercial and residential. And the very bottom bullet point is important. 56% said the project would have been smaller in scale, and 40% of the realtors said that the transaction would not have happened at all without a 1031 exchange. So you'll see some different numbers. Ernst & Young said a negative $13 billion reduction in GDP. Tax Foundation came in at negative $18 billion. So if you want more information on this, a great website is 1031taxreform.com. Has a lot of great information on it. And if you want, you can contact your representatives here in Colorado. I've spent quite a bit of time talking to them myself, but certainly welcome all input. Anytime your clients do an exchange, they're going to have to fill out, when they do their taxes, IRS Form 8824 has to be completed with each and every exchange. So just keep that in mind. That's something their CPA will prepare. And when we look at kind of the selecting a qualified intermediary, the most important thing you want to look at is the security of the funds. Intermediaries sit on a lot of money. For those of you that have been in the industry for a while, you remember not too far back, there was a bankruptcy involving a company here in Colorado. It involved a parent company called the 1031 Tax Group, but it was a $132 million bankruptcy. And the company in Colorado and Denver was a big part of that. There have been other losses. There was one in Vegas, Las Vegas, with about $100 million. The largest was Land America Exchange, $420 million. So the security of the funds is the #1 issue. What I want to do is give you some factors to consider when you look at that. Does the QI offer the backing of a large entity, a large creditworthy entity. So there are QIs that are subsidiaries of title companies. There are QIs that are subsidiaries of banks, but that can provide an additional layer of protection. You certainly want to look at what's the financial rating of the parent company. You know, how solid is their balance sheet? What do they have in assets? And you certainly want to look at, does the QI perform due diligence on the banks and financial institutions where they deposit the funds? That can make a big difference. Now, what I want to do on the next slide is bring up probably the most important thing to look at when you're looking at a qualified intermediary. And unfortunately, a lot of people don't ask this question, but I think it's very important. So you as a closing officer, if you're going to make a referral of a qualified intermediary, first off, I suggest you make a number of referrals. Maybe not refer just one company, but maybe give them 3 or more referrals. But the issue that you want to look at that I think is very important is the top one up here. Does the qualified intermediary offer a segregated account? You don't want the investor's funds to be commingled with any other investors. You want each investor to have their own separate account, which is their own funds. So I know we as an intermediary, after we receive their funds, we'll let them know what specific account their funds have been deposited in. We'll let them know the 45 and 180 days. But this is the most important question. Your QI can also provide an escrow or qualified escrow or qualified trust account. You certainly want to see if they have sufficient fidelity bond coverage. Here in Colorado, we have a consumer protection law for qualified intermediaries in the state. So in Colorado, there's a minimum fidelity bond coverage of $1 million. And even though that sounds like a big number, I'll tell you in the qualified intermediary industry, a lot of QIs have balances that they hold for their clients that are a whole lot more than $1 million. So it's a reasonable threshold to provide some consumer protection, but I can tell you, you want to find out what is the fidelity bond coverage offered by the qualified intermediary. A great resource is the industry trade organization, which is known as the Federation of Exchange Accommodators. Their website is 1031.org. So they're a great place to look. A lot of credible companies, in fact, most credible intermediaries are going to join and subscribe to the Code of Ethics of the Federation of Exchange Accommodators. So you can go to the website, 1031.org, and then you can select qualified intermediaries here in Colorado and get an idea if they're a member of that group and if they subscribe to that Code of Ethics. So that's just another layer of protection. Kind of wrapping up here and coming down home stretch, and hopefully my voice has been pretty good. I've been struggling a little bit of a cold today. If you've got questions, you know, specific questions, a good qualified intermediary should be a resource to you. My contact information is there. APIexchange.com is a website. The email info@apiexchange.com goes to senior management. So if you've got a question about how to structure something, feel free to give us a call. We want to be a resource to you in Colorado on questions that you have structuring transactions, on questions with settlement statements and how to do things. Now remember, a qualified intermediary doesn't replace the investor's tax advisors or legal advisors, but we can give you a lot of input on the 1031 aspect of a transaction, what the rules are, what do the Treasury regulations allow and what they don't. So, you know, the bottom line is we certainly want to be a great resource to you personally and to your investor clients and the brokers and real estate agents that you work with around the state.